Your money-making broadcast starts now. Markets ended the session mixed but mostly flat in what appeared on the surface to be a quiet Monday. The S&P 500 slipped less than 0.1% to $738.61. The tech-heavy Nasdaq Composite shed 0.4%. The Dow Jones Industrial Average managed a modest gain of 0.3%. Nothing dramatic on the headlines. But beneath the surface, this was truly anything but a quiet day. Bond yields surged to one-year highs across the curve, with the 10-year Treasury touching levels not seen since last spring. This bond market move is the single most important signal for equity markets in the weeks ahead. Canadian inflation data confirmed that price pressures remain stubbornly entrenched, complicating the Bank of Canada's policy path. Kevin Warsh officially takes the Fed chair this Friday, and the entire rate narrative is being rewritten in real time. For Canadian investors, this week is shaping up as one of the most consequential of the year. The Bank of Canada finds itself trapped between a stubbornly high domestic inflation picture and a Fed that is about to pivot back toward tightening. Meanwhile, the TSX Composite declined along with the small-cap IWM index as interest-rate-sensitive sectors took the heaviest losses. The TSX heavy weighting in financials, energy, and materials leaves it uniquely exposed to the crosscurrents of rising rates, geopolitical tension in the Middle East, and the AI earnings supercycle culminating in NVIDIA's highly anticipated earnings report expected this week. Let's break down what really happened today, why it matters for your portfolio, and where to find opportunity in a market that looks calm but is anything but. The single most important story today is the Warsh effect. Kevin Warsh will be sworn in as Federal Reserve Chair this Friday. This is not a routine succession. Warsh is a known inflation hawk. His appointment signals a definitive end to the Powell era of rate cutting. The April CPI came in at 3.8%, the highest since May 2023. The Producer Price Index surged 6%. Consumer sentiment hit an all-time low in the May reading. Together, these data points send an unmistakable signal: the disinflation narrative is dead. The market is now repricing for a July rate hike. The 10-year Treasury yield jumped to its highest level in a year. Japanese 30-year bonds hit an all-time high. Global bond markets are in full repricing mode. For Canada, the implication is direct and sobering. The Bank of Canada cannot cut rates independently of the Fed without crashing the loonie and importing even more inflation through a weaker currency. Canadian bond yields are rising in sympathy. The TSX interest rate-sensitive sectors felt it immediately. The small-cap IWM index fell 0.6%. Rate-sensitive growth stocks took the worst hits. Enphase Energy, or ENPH, plunged 6% as solar stocks got crushed by the rate repricing. Enbridge, the Canadian energy infrastructure giant, saw its defensive pipeline cash flow profile attract income-seeking capital. The Warsh effect is the defining macro narrative for the second half of 2026. Story 2 is all about artificial intelligence, but with an important twist. The market is increasingly drawing a line between AI hardware names that have already priced in massive expectations and AI software names that are just beginning to monetize. This distinction matters because it determines where the next wave of returns will come from. NVIDIA reports earnings this week, and the options market is flashing anxiety signals with elevated implied volatility. The stock slipped just over 1% today in a wait-and-see posture as traders position ahead of what could be the most consequential earnings report of the year. On the software side, the picture is much brighter. Salesforce, trading at $179.48, surged 3.4% today as investors rewarded its AI monetization progress through the new Agentforce platform that is already driving measurable customer outcomes. Cisco beat earnings and confirmed that AI data center infrastructure demand is ramping hard across enterprise customers, not just hyperscalers. The networking hardware space is a direct beneficiary of the AI build-out cycle. For Canadian tech investors, Shopify, trading under Shop on both the TSX and NYSE, remains the domestic AI beneficiary to watch. Its e-commerce AI tools like Shop Assistant are gaining real traction with merchants globally, helping them automate customer service and marketing workflows. When the software layer of AI begins to monetize broadly, Canadian SaaS companies with global reach like Shopify and its peers are positioned to participate in what could be a multi-year growth cycle. Story 3 is a tale of two sectors moving in opposite directions: space and energy. Rocket Lab surged 5.1% to $131.16 as SpaceX's accelerating IPO timeline creates a powerful sector catalyst. The space race is real, institutional money is flowing in, and RKLB is the purest publicly traded play on the theme. On the flip side, Virgin Galactic collapsed 8.2%. These two stocks could not be more different. Rocket Lab has a real business with recurring launch revenue. Virgin Galactic is still burning cash with an uncertain path to profitability. Canadian investors should take note that space is becoming a genuine institutional theme. Meanwhile, energy stocks showed relative resilience despite oil pulling back 2.8% to $102.46. Canadian energy giants Enbridge, Suncor Energy, and Canadian Natural Resources remain structurally supported by elevated crude prices, pipeline infrastructure demand, and strong free cash flow generation. ENB in particular combines a regulated pipeline toll booth model with a 6% dividend yield that income-focused Canadian investors have relied on for decades. Energy infrastructure toll booth businesses offer a rare combination of defensive utility-like revenue and exposure to commodity upside. Bringing this all together, today's market was a textbook example of what the legendary global value investor John Templeton called the point of maximum pessimism. Markets look calm on the surface, but beneath it, a major regime change is underway. The shift from rate cuts to rate hikes, the AI hardware versus software divergence, the space sector emergence, and the energy infrastructure stability all tell different stories about where we are in the cycle. Canadian banks like RBC and TD face margin pressure from rising rates, but also benefit from wider net interest spreads when the yield curve steepens. The VIX closed at 17.8, down 3%, suggesting the market is complacent. Complacency in the face of three converging catalysts, Warsh's appointment, Nvidia earnings, and the Iran Strait of Hormuz crisis, is historically dangerous. When everyone is calm, that is precisely when the shock arrives. For Canadian investors, the message is clear: diversify across sectors, hold high-quality dividend payers like ENB, maintain at least 30% cash reserves, and be ready to deploy capital when volatility inevitably returns. Nvidia reports this week. Warsh takes office Friday. The next 5 days will define the market direction for the rest of the quarter. Let's examine for stock picks through the lens of investing legends. For the safe anchor in your portfolio, the father of value investing, Benjamin Graham, would choose Enbridge. At current levels, ENB offers a 6% plus dividend yield backed by regulated pipeline cash flows that are virtually recession-proof, deeply resilient, and highly predictable over time. The margin of safety is built into the toll booth business model. The company moves 30% of North American crude, and its revenues are largely fee-based, not commodity price-dependent. For the balanced growth pick, the legendary growth investor Phil Fisher would point to Salesforce at $179.48. The CRM story is about successfully transitioning from a SaaS platform into an AI-powered enterprise software ecosystem. Its 3.4% gain today reflects genuine momentum that Fisher's scuttlebutt method would detect through customer conversations about the new Agentforce AI product. For the aggressive growth pick, the disruptive innovation fund manager Kathy would bet on Rocket Lab at $131.16. SpaceX's IPO timeline is accelerating, and RKLB is the best-positioned publicly traded pure play in the orbital launch space. The S-curve of the space industry is bending upward, and her framework of exponential disruption fits this story perfectly. For the value-conscious investor, the legendary Fidelity fund manager Peter Lynch would pick Ford at $13.03. It is an affordable stock with a 5.8% dividend yield, a brand Canadians know intimately, and a new energy transition narrative that adds optionality without sacrificing its legacy cash flow. Lynch would say this is exactly the kind of simple, understandable business that everyday investors can analyze themselves, completing a balanced and well-diversified portfolio. These four stocks span the risk spectrum and offer Canadian investors a balanced approach to navigating a week defined by major regime change. Markets closed mostly flat today, but the crosscurrents beneath the surface are building toward a major inflection point. Stay disciplined, stay diversified, and keep cash ready. That is the market close for May 18th. I'm Chloe. Don't forget to like and subscribe. See you at 7 a.m. Eastern for shorts. Check our shorts for a 60-second highlight. That's all for today. We all become wealthy together.